So I wanted us to have a little discussion about what we just talked about and about money itself before jumping into the material of the course and, getting into the trading, because I find it very interesting and it's very important for us, to think about this higher level concept of money because things might change, right? So we've talked about the fact that money here has to serve several functions, right? And these functions are, one, serve as a medium of exchange, right? Two, be a store of value. And three, be a unit of value. And we said gold was used because, it was scarce and was durable and, I don't know what else, but, it has to be scarce. Now, a problem now that we're having is, yes, money serves this very well. It is a medium of exchange. It stores value. Well, stores value. It's a unit of value. You know that a computer costs this, an iPhone costs 1,000, all of that stuff. Now, the store of value is not great because your money loses value with time, okay? And that's a bit of a problem, okay? The government can come tomorrow, and I guess this ties into with this. It's not very scarce because the government can come tomorrow and say, you know what? We're going to print 2 times more money. And then your money has way less buying power because it's worth less because there's way more money, right? And that's a problem because the government can come in, you make $100,000, they tax half of it, and then you're left with 50. And let's say you save it, but then the next year they decide to print way more money, and then your currency isn't worth as much, right? And it's worth nothing, and you have to work more, and then you work more and they tax it again. So then they're forcing you to work again, and the money you've already made isn't worth as much anymore now. And that's not nice. Okay. And this is why we have something that came along like cryptocurrencies, and people really see that, okay, well, this might be, the future of currency, because we've seen that currency changed. It can change several times. There could be something else that comes out. Now, the problem with cryptocurrency is, well, let's talk about the good points. The good points is it is scarce. So you can have something like Bitcoin, which is there's 21 million coins maximum, and there's never going to be more than that. So you know that if you have one of them and we agree that this is the currency that we're going to use, you're not losing value with time. It's actually going to gain value, right? But the problem with cryptos is it's not a unit of value. And if it doesn't fulfill all of these three, it doesn't work. So I cannot come and say an Apple is 0.1 Bitcoin. I can't come and say an iPhone is 0.5 Bitcoins. I can't, because the price of Bitcoin fluctuates so much, right? So this causes a problem, and we can't go to that because of this. But, maybe they're going to fix that in a way, right, in the future. And if it does, then people might not want to hold their currency anymore, their paper fiat currency, and use another currency, a global currency, maybe. So all of this you have to be aware of because, we're living. We're going to experience these things that are going to happen. You always, people, when they look at dollar money, they're like, well, no, it's always been like that. No, it hasn't. It's only been 50 years. 50 years is nothing. So our parents, or if you're over 50 years old, then you've seen currency that was actually gold. It was, you could use an IOU, but it was actual gold. The IOU itself was worthless. So, people who say like, well, it's impossible that change. It's been like that forever. It's not true. It's only been like that for 50 years. So there's a very high probability for it to change. And if it changes, well, you have to be aware of that, because if you're trading in that market, you can make a huge event-based trade that will change your life. So just being aware of these things and thinking about them puts you in a position that when something actually happens, you will have the confidence to put in money and execute a trade that can make an impact for you. So how are we actually going to generate money out of the currencies market, right? Because this is the objective of the course. Learn about the foreign exchange market in order to be able to generate money out of it. So in the lectures that we've went over on the history of money, we understand now that each country has its own currency, right? I live in Canada, so when I go to pay for something, I use Canadian money, Canadian dollar bills. So this is a $20 Canadian bill. But when I went on vacation to Mexico, I couldn't pay for stuff with this bill. I had to use pesos, right? So I had to convert some of my Canadian money to pesos in order to buy stuff there. Now the rate is not constant, like we've saw from the previous lectures, because each currency isn't backing up their currency by gold. And then you could say, well, if this is worth this much gold and this is worth this much gold, then this is worth this amount of that. They're just floating. Okay, so it's based on supply and demand. So how many dollars would give me how many pesos? Well, it depends on the rate. So let's say this. Let's say you're going on vacation. Let's say I'm going on vacation. Okay, and I'm going from, I live in Canada, but let's say for simplicity, let's say you're living in the US. And the rate right now from US to pesos, okay, and let's just write it like this. If you want to bring $1 and convert it to pesos, $1 would give you 20 pesos. Okay, this is the current rate. So you have, you're going on vacation, you're like, okay, well, you know what? I'm going to bring $100. Okay, let's say it's a short trip. You bring $100. Well, you go to the exchange place. You could go to the airport or wherever, and they exchange $100 and you get 2,000 pesos. Now, you stay there for a week. And let's say when you go there, you ended up not spending any money. Your friends paid for everything. You have really cool friends. You didn't spend anything. So you come back to the States, and then you're like, well, I have all these pesos here. What am I going to do with them? Right? What am I going to do with these 2,000? I want to convert them back to US. Well, the currency rate, the exchange rate might have changed, right? It could be something different now. So let's say that when you're coming back, the exchange rate changed, and now the new rate is $1 will only give you 16 pesos. That's the new rate, right? So this would mean that pesos actually gained in value. So $1 can't get you as much pesos as before because pesos are more expensive. So, it takes time to understand this. So if $1 gets you less of something, that means that that other thing became stronger. It gained in value, okay? So how many US dollars are you going to be able to get back with your 200 pesos? Well, you have those pesos that are more valuable now. So you'll probably be able to get more US dollars. So what you would do is, well, 2,000 divided by 16, right? So I'll open a calculator here. You get 2,000 divided by 16, because each 16 pesos are going to give you $1. That gives you $125. So you go back to the airport and you go see the exchange shop and you convert it back, and now you get 125 US dollars, making in profit, right, $25. Because you had 100 initially, but now you ended up having 125 bucks. So you made $25 because of that exchange rate fluctuation. Now, if the exchange rate changed differently, meaning the pesos, $1 could bring you, 30 pesos, well, you would have lost money because pesos wouldn't have been worth as much anymore. Okay. Now, are you really gonna do this to make money? Are you gonna go on vacation and not spend money? No. You can just convert the money, keep it. If you had some analysis that told you, you know what, I think the peso is gonna strengthen, so I want to hold pesos right now, because in relation to the US dollars, it's going to strengthen. So I'm going to hold it and then I'm going to convert it back. You could have made money like that without even going on vacation. But you don't want to go to the exchange shop and exchange money because there's fees and stuff like that, and there's time. You can open an account with a broker, which we're going to do all of that, and do it from home. Do it from your cell phone. It takes seconds, right? And this is what we're going to be doing. We're going to be speculating on the exchange rates and try to generate money out of it. Now, what is the actual exchange rate between US and pesos? You can actually just Google it. US to pesos. And here, so $1 US is 18.77 Mexican pesos right now. So if you change it right now, it would be for that amount. Now it changes all the time, every minute. It's different, right? But we'll look into that in the next lectures. So I gave an example about converting US dollars to Mexican pesos. I said it was $1 US to 20 pesos. Well, what is that? How do we talk about this? When you talk about a currency in relation to another currency, we call this a currency pair. So you'll often hear this term, what currency pair are you trading? Which pair are you looking at? So a currency pair is just quoting one currency against another. So USD to Mexican pesos, or any combination of currencies. Now, in this currency pair, there's two currencies. You have the base currency and the quote currency. The first one is going to be your base currency. And the second one is going to be your quote currency. So if, let's say for the previous example that we had, and I said USD, let's see here, USD to Mexican pesos, okay? Well, we would have said that this here, the USD, this is what we would call our base currency. Okay? It's our base currency. And the Mexican pesos is our quote currency. Okay? So this would be the base currency and this would be the quote currency. Okay? Because you're saying the base currency is always one, right? So you're saying $1 US, how much can that give me in Mexican pesos? So the first one, the base currency, is the one we're relating to, saying, well, how much one of this is going to be worth in the other one. And the other one, the second one, the quote currency, is the one we're quoting. So we're giving a quote on it. We're saying, well, we're quoting a price of $20, 20 pesos for this $1. Or we're quoting at 18 pesos 0.7 for $1. Okay, so this is the base currency, quote currency. Now, the way we write these currencies, why didn't we just write US? Or why didn't we just write peso? Why did we write this? Because each currency is identified by its ISO currency code. ISO stands for International Organization for Standardization. And basically, if I open it here, okay, so you'll see that for each country in the world, you have a code, right? The ISO code. And this code is 3 letters. And let's say if I go to Canada, and it's just a standard, so everybody can understand each other. For Canada, the code is CAD, so CAD, and it tells you here Canadian dollar. If you want to go, I don't know, China, CNY, yuan, right? Yuan, renminbi. Those just call it yuan. So you have for each country. So if you don't know what the code is for the country you want to trade, just go on this list and you'll find it. If you want to go to the United States, you have USD, US dollar. Okay, and don't bother with these. Don't need to look at those. And yeah, so you have all these countries here, and you can just Google ISO code and you'll get to a bunch of different websites that have the same codes. Now, let's just go back to pound it in just a bit more. So if you have a currency pair of, let's say, USD CAD, and the price is 1.35, you would say that the base currency is USD, quote currency is Canadian. And so this is the quote for the USD against Canadian dollar. The quotation of 1.35 means that $1 US can be exchanged for 1.35 Canadian dollars. So keep this handy if you always get confused. But by the end of this course, this for you is going to be something very simple. So not all currencies are equal. And when I say they're not equal, I'm talking about trading liquidity. So not all currencies are traded as much as one another, right? And you probably know that the currency that is the most traded is the US dollar. And it's actually the most traded when you compare it to other currencies. The second most traded one is the euro, and the US dollar is traded 3 times more than that around. So it's very, very liquid. Now, the countries or the currencies that are most traded, we call the major currencies. And this is the list of the major currencies here. Now, I didn't put them in order. It is true that the US dollar is the most traded one. The euro is the second, but I didn't really put these one in order. They might be, they might not be. But yeah, you have the Japanese yen. That's very much traded as well. The British pound, Australian dollar, Canadian dollar, and Swiss franc. So these are the major currencies. Now, because of that, we have what we call the major currency pairs, right? And these are just pairs that are very, very liquid. So very widely traded. So you're not going to find pesos to, I don't know, Japanese yen. It's not traded as much as these ones, okay? Or even pesos to something else, a country that's not even a major. So you have the pound sterling to USD, which some of these have like nicknames. So we call this one the cable, but you don't really need to learn those. You have USD CAD, people call it the loonie. The Australian to USD, we call it the Aussie, so Australian dollar. Then this is USD to Swiss franc, so people call it the Swissy. USD to Japanese yen, Euro to USD, and New Zealand dollar to USD. So these are the major currency pairs. You'll see these often, and you're probably going to start by trading one of these currencies, okay? Now, you might be wondering, why do they have USD CAD and not CAD USD? Or why do they have here USD first, and then here you have USD second? Like, can you trade them, USD to Euro or Euro to USD? Well, there's a convention, and the convention goes as this. And, this is outside of course material, but it's just for your general information. Why do they do that? They have like a rule, and the rule is like, if there's a euro in the pair, the euro is going to go first. Okay. But then second, the pound sterling. So if there's a euro and pound sterling, then the euro will go first, pound sterling goes second. But if there's no euro, then the pound sterling is going to go first. Okay. So here, if there's not that, Australian dollar goes first. If not that, New Zealand dollar. If not that, US dollar, Canadian dollar, Swiss franc, Japanese yen. So this is like the rule that they have of which currency goes first. And this is, sometimes people, wonder, why is it like that? This is their convention. Now, for the other currencies, so let's say pesos or any other currency, which we call the minors, they're generally quoted against the USD, right? So you're going to see them next to the USD. That's how most people are going to trade them. Now, if you're not trading them against the USD, what we're going to call this pair is, we're going to call it a cross pair. Okay. So a cross pair is any pair that does not include the USD. So let's say, even if I'm looking at CAD, Japanese yen. Okay. So now you know what currency pairs are, cross pairs, major pairs, and we're ready to move on to the next lecture. So now that you know what currency pairs are, what are you going to do if you want to exchange a currency or buy or sell a currency versus another currency? We've already came to the conclusion that you're not going to go to the airport to exchange your currency there. You're not going to go to one of those foreign exchange shops. You're going to do it from home. Well, how are you going to do that? To know how you're going to do that, you need to understand the market structure in the foreign exchange world. The thing with FX is that it's a OTC market. What is a OTC market? An OTC market is a over-the-counter market, meaning that there's no central exchange where you go to transact on. It's not like the stock market, where if you want to buy a particular stock, it's listed on only one exchange. Like, let's say NASDAQ or New York, you have to go to that exchange to buy or sell that stock. In the FX world, it's not like that. If you want to buy US dollars, you don't have to go to the Fed's office to buy US dollars. You can do it anywhere with anyone. So it's over the counter. And because it's over the counter, execution prices will vary, right? This is a big thing. So if you want to buy some pesos, well, if you go to the airport, they might give you a really bad rate because they know you need it. If you go and you exchange it there in somewhere very touristic-y, it's going to be, more expensive. But if before that, like before I went to Mexico, I called a few shops here in Montreal and I started negotiating the prices. They told me, we're giving it to you for $14. And so I called somebody else. They said $14.20. I'm like, well, somebody else, I lied. Somebody else told me $14.30. Can you give me more? Okay, we'll match it. Okay, I'll take it. So, you can negotiate if you're doing something like that. But if you're trading online, the rates are going to be very thin. You can't call and negotiate. But depending on where you're buying from, you might have better rates, right? So it's important to know that the rates are not going to be the same everywhere. Now, the actual structure is like this. You have the interbank market, and the interbank market is where the huge banks transact with one another, okay? Now, these huge banks, they can transact through EBS, which is the electronic brokering services, or Thomson Reuters. These are the two options. They basically provide a order book for all the huge banks, okay? And when I'm talking about huge banks, I'm talking about Deutsche Bank, UBS, Citigroup, Barclays Capital, RBS, Goldman Sachs, HSBC, Bank of America, JP Morgan, Credit Suisse, Morgan Stanley. The huge banks. These banks account for approximately, I think, somewhere between 60 to 70% of all the volume of all the transactions that happen in the FX world. Okay. So they have this order book where they can transact directly with one another. Okay. Now, this is only available for huge banks. You cannot go and trade there. It's billions and billions of dollars every second. It's huge amounts of money. Okay. So where do you come in? So this is the players, right? And the huge banks that I talked about, this is what we call the FX dealers. They're on the top. Now, other participants can't just go and trade with them. They can't go and get on this order book and say, I'm going to buy at this price, I'm going to sell, because they're too small, right? They're not going to accept them. If you want to trade, you have to go through one of them, okay? So the second level here is other big participants, and these could include other banks, right? So local banks that you know of, large companies, hedge funds, very big participants, okay? And these guys would go through one of them. They can go through, let's say, HSBC, or they can go through JP Morgan. They can go through one of these dealers. Now, where are you? You're still not at this level, because this is still huge money, okay? Now, there's another level here, and this is the level you're going to go through. You have Forex brokers and retail ECNs. We can just call this brokers, okay? And I'm going to talk more about brokers in general in the next section, or in a few sections maybe. But these are going to be people who take care of getting an execution for you, right? So you have to go through them. So a broker here is going to be going through one of these banks, which this bank is going to be going through one of these FX dealers, okay? So like there's a few steps here. And you have to open an account with one of these brokers. It's like when you buy a house, you get a broker, and the broker is responsible to get you the house that you want. Same thing in Forex. Or in stocks, you want to buy a stock. You open an account with a broker, and the broker, you give him your order, what you want to buy, and he tries to get you executed on that. Same thing. You want to buy, pesos. You want to trade that. Well, you open an account with one of those brokers, and you send your order. Now, what the broker is going to do, there's a bunch of different types of brokers, which we'll talk about later. He'll either take your order, batch it with other traders, and because otherwise you guys are too small, right? And send it over as a larger order. So it gets accepted. He has a deal with one of these other banks, and this other bank gets it executed, and you get your fill. Now, some other brokers take the trade against you. So you want to buy it, they'll sell it to you right away, right? But then as soon as they sell it to you, they might hedge their order by buying it from another bigger bank, and they're going to have their own rules. They might be able to hold some risk. They might only hedge their risk if they have exposure to one currency way too much. But what you need to know is that basically you're going to have to open an account with a broker, and your level is like way down there, right? So you're going through multiple people to get your execution. We'll talk more about brokers later, so you know which broker you should open an account with, because they don't all have your interest in mind. Some of them just want to make money off of you and that's it. But we'll talk about that later. But this is really the structure, and now you know where you are within it. So it's time to get into the terminology here, because to be moving forward, we're going to be using some, I guess, trading jargon or Forex terminology. So you need to know it for us to, advance and look at brokers and look at charting and all of that nice stuff. Okay. So these are some words we're going to be using often. So spot price. What is the spot price? Or you might hear, this is just the current price of a currency pair, right? So when I went on Google earlier, or if I go on a charting software and you see the price, this is the spot price. This is the current price, the last executed trade, right? The last transaction that happened on that broker is going to be the spot price there. Okay. So then we have the order book, the bid price, the ask price, and the spread. And I think the best way to explain this here is through a little example. So the order book, okay, is going to be basically, I'll put it here, order book. Okay, this is going to be the book with all the buyers and all the sellers. So let's say you want to buy, and let's keep with the USD to Mexican peso example. Well, you'll have the buyers, so people who want to buy Mexican pesos with USD. So let's say somebody wants to buy, at 20 pesos per US dollar. Okay. Well, somebody else wants to buy at 19. Maybe somebody else wants at 18.50. Right. There's a bunch of buyers, and this is the price. There's gonna be a quantity too as well, but let's just assume there's just the price for now. And then you have sellers as well, right? And sellers, somebody might want to sell at 21. Somebody else might want to sell at 21.50. Somebody else might want at 21.99. Somebody else at 25. So here you have the buyers, and here you have the sellers. Okay, so we have buyers and sellers. Now, what we're going to call this is the order book, because it has all the orders for all the people who want to buy and sell. These are open orders. Now, if somebody comes in and says, well, I want to buy Mexican pesos at 21, and somebody is willing to sell them at 21, this order is going to be removed as long as they have the same quantity, and it's going to come off the order book. Okay. And it will just show up as a transaction that happens. Okay. But as long as somebody is waiting and wants to get filled or wants to get executed, they want to, place that trade, have that execution, but it's still not executed. It's part of the order book, right? And when I talked earlier about the big banks going through Thomson Reuters, well, they have an order book and they see who wants to buy how much at all these levels. Now, in the order book, the best buyer here, or the buyer who's willing to pay the most, we call this the bid. Okay. And here, the seller who's willing to sell at the lowest amount of price, we call this the ask. So the bid here, and if I put this back here, the bid price, okay, is the buyer who's willing to pay the most. Now, if you want to sell right now, this moment, what price can you sell at? You can sell to the guy who's willing to pay the most, right? So when you're looking at the bid price, you can think of it as, if I want to sell right now, I can sell at the bid price. Now, the other way, if you want to buy right now, where can you buy? You're not going to put your order, if you want to buy, we'll go back here. you're not going to put your order here and be like, I want to buy here, because then you're just going to have to wait until somebody sells to you. It's not how. So if you want to buy right now, you're going to have to buy at the ask. Okay. And the difference here between the bid and ask, we call this the spread. The spread. Okay. The spread. The spread is going to be the difference between the bid and the ask. And the spread is kind of like your commission, the cost. Okay. Because let's say right now you want to pay, you want to buy this currency, and you buy it at 21. Okay. So you buy at 21, and then right away you turn around and you sell it at 20. So you just lost $1, right? A peso. So you just lost that. So you buy it at 20 and then you sell it. So let's put here. So you buy at 21 and you sell it at 20. So you lost the spread. So the spread is your commission. Okay. So you want something that has a low spread, right? If, let's say, in this case, you lost $1. But if the prices were different here, if let's say here the ask was, let's say, 20.50 and the bid was, let's say, 20.40, well, if you would have bought at 20.50, okay, at 20.50, and then sold right away at 20.40, you would have only lost 10 cents. Okay. So you want to make sure that when you're trading something, you have a small spread. Now, this order book, most of the time, you're not even going to see it. You're not going to see all of these things, and you're only going to be provided the bid and ask. And with a lot of brokers, they won't permit you to place your order in the order book and transact with other clients, right? Some of them would, but others will just give you those prices, and they're gonna be trading against you. So, oh, you want to buy? Well, they'll sell it to you at that price, and they'll handle in the background getting it or doing whatever. Okay, but then they might have a different spread depending on the time and the volatility of the market, because if they can get this currency at, let's say, 20.48, okay, and they'll sell it to you for a higher price, they'll do that. Okay. But then the problem is if they give it to you at 20.48 and then by the time they get it, or at 20.50, sorry, and by the time they get it, the price really moved, there's risk. So they might widen their spread when the market is moving a lot, okay? And we're going to get into that when we talk about brokers, but this is something that you want to, keep in mind. This is the terminology for, spot price, order book, bid price, ask price, and the spread. The next words you want to get familiar with is pips. So you have point, pip, and pipette. So we'll start with pip. A pip is a change in a currency by 0.0001. Okay? So it's the fourth decimal place here. So when you're looking at currencies, I'm going to pull up a chart here. We're going to go over charting later, so I'm not going to explain any of it here. But you'll see that something like this, let's say I'll go USD CAD. Okay? You'll see something like this here. The last executed trade is at 1.33916. It's not just $1.33. We're going more than that. We're being very precise because you can buy something at a very precise point. You're not going to buy something USD CAD at $1.33 and then wait until it goes to $1.40 because currencies don't move as much. You'll see that this is, this is a daily chart, but we'll go into that later. Currencies move often just few cents, less than that. Sometimes they stay within, a 1 cent range for months. Okay. So what you're trading is sometimes smaller movements. So we go into several decimal places. So you'll see here, even when you're looking at the last price, that you have the USD CAD at 1.3391. So this one here is a pip. So if it goes from 1.3391 to 1.3392, then it went up by 1 pip. If it goes from 1.3391 down to 1.3381, then it went down by 10 pips, right? Because this one here is a 1 pip. Here, let's say, if this goes up from 0.6685 to 0.6687, then it went up by 2 pips. So from 5 to 7. So this is a pip, okay? Now, we became so precise now that we've actually also added something else. We've added a pipette, which is 5 decimal places down. So 0.00001. So we're even more precise. So you'll see here, this small 6 here, that's a pipette, right? So if this currency goes from 1.33916 to 33918, then it went up by 2 pipettes, right? Usually we're going to be talking in terms of pips, right? So this is going to be the thing that you're going to hear most often, and there's a lots of reason for that. Even when you're calculating how much position you're buying or profits and losses, we're always going to be talking in pips. Hey, I'm buying this and I'm trying to make 50 pips on it. I'm trying to make 40 pips, and in your head, we'll do the math later, that if you make 50 pips, you'll make this amount of dollars, or you'll make this amount of dollars. You'll also know how much money you're making per pip. So if it moves up 10 pips, you're making 10 more times the money that you've calculated. And then a point is just the minimum change. So for different currencies, most of them now are going to be in pipettes. So the minimum change is going to be in pipettes, but we call that a point. But the one that you really want to remember is pip. Next word to get familiar with is lots. So a lot is the standard measure of units, okay, when you're trading currencies. And a lot, which is a standard lot, okay? But whenever we're talking about a lot, we're talking about the standard lot. A standard lot, so when you're buying one lot, you're buying 100,000 units of the base currency. So if I'm looking at USD CAD, well, here, USD CAD that we just looked at, what this means is I want to buy $100,000 of this currency, but I want to pay 100,000 US dollars. Okay, I'm putting in 100,000 US dollars. Now, how much will it cost me in Canadian is going to be more, because a Canadian dollar is 1.33 for each 1 US dollar. So it'll cost me 133,000 Canadian dollars. But remember, we're always talking a lot is in the base currency. We're putting that amount of money in. So if you're buying any currency, we're saying one lot, meaning you're going to buy for an amount worth $100,000 of the base currency. Now, you might say, wait, I don't have $100,000 to trade with. How come one single lot is $100,000? Well, don't worry about it. I'm not expecting you to have $100,000 to trade with or anything near to that, especially if you're starting off. You want to start off with a very small amount of money. Or even just paper trading, which we'll talk about later. But your broker is going to be lending you a lot of the money that you're going to be trading with. So nobody trades Forex with their capital. They borrow money from their broker to trade. And the reason for that is that currencies move by small amounts, right? So if we talk again about, let's say, USD CAD, well, if you have $100, let's say, and you buy USD CAD, and there's a move that happens, and it goes from $1.33 to $1.34, which a cent move is a big move in currencies. Well, how much are you going to make? You're going to make $1, and that's on a big move. Okay. So you're not going to trade with $100. You're actually going to trade with way bigger amounts. So you're going to put that $100 at your brokers, and your broker will tell you, well, we'll let you trade with 100,000. Will loan you the rest of the money. So even if the currencies move a bit, you'll make way more money. But if it moves against you, you'll lose way more money. But that's what we call leverage, and we're talking about that in another lecture. I just want to comfort you in knowing that, when we're talking about big amounts of money like that, even though you will be trading big amounts of money, you're not putting it up. You're putting a fraction of it up, and we'll talk about that later. But this is going to be your standard lot, 100,000. Then some brokers started introducing mini lots, right? So mini lots, so you trade with smaller amounts. So it's 10, and this has been there for a long time, mini lots, 10,000 units of the base currency. But something more recent was the micro lot, okay? And the micro lot was just 1,000 units, which is extremely small, okay? So one lot is going to be this. 0.1 lot is going to be this, which is the mini lot. 0.01 lot is going to be the micro lot, which is going to be this. So we've looked at what pips are, and we've looked at what a lot is. Now, the next thing that you need to learn is pip value. Pip value is composed of pips and lots. So that's why we had to view these two first to be able to calculate the pip value. Now, pip value calculation is basically you saying, well, how much am I going to make in dollars, in money, for each pip movement that this currency makes? So every pip that it moves up or down, how much am I winning or losing? For example, let's say you have USD CAD. So this is the current price of USD CAD. Now, how much would it cost us to get one lot of this? Well, we know that one lot, okay, one lot here is going to be 100,000 of the base currency, which is USD, times 1.35251 is going to give you 135,251 Canadian dollars. That's the contract value. That's how much it's going to cost us to get this one lot, right? And don't worry, we're going to talk about leverage in the next lecture, so you'll know that it's not going to cost you that much. Now, the pip value is the profit that you're going to make for each one pip movement. So what's one pip? We know that a pip is 1, 2, 3, 4 decimal places after the zero. So it's 1 here, right? So that's a one pip movement. So we want to know what happens if the price goes to 6 here instead of 5. Okay. So instead of having 5, it goes to 6, or it goes down to 4. It moves by 1 pip. Well, let's see. What would be the contract value if the price went up by 1 pip? So to 1.35261. Well, the contract value would be 100,000 US times 1.35261, which gives us $135,261. Now, the pip value, so in this case, if this currency moves up by 1 pip, how much money would we have made? Well, we would have made, 135,261, the price at which we're selling, minus the price at which we bought at, 135,251, we would make $10. Okay, $10 in Canadian. Now, if you want to know how much you made in the base currency in USD, well, all you would have to do is do the $10 divided by the exchange rate, which in this case, it would have given you 739 in US. Okay. Now, when we're talking about pip value, it is usually calculated, well, it is calculated in quote currency. So when we're talking about pip value, you're usually talking about quote currency. But if you want to look at it in the other currency, you can do that. The value of the pip is going to be based on how many lots, right? So in this case, I calculated that you bought 1 lot. But imagine you didn't buy 1 lot and you bought 0.1 lot, right? Because you didn't want to spend 100,000 US, you want to spend 10,000 US, right? Well, in this case, what would have been your pip value? It would have been 10 times less this. So it would have been $1, your pip value. If you wanted to trade 0.01 lots, okay, so 100th of a lot, meaning you just wanted to trade in 1,000 increments, well, what would have been your pip value? Well, 10 times less than this one. So it would have been 10 cents, right? That would have been your pip value. So the pip value is going to depend really on the lots, the size of the lot that you're using. Are you trading 0.1 lot, 1 lot, 10 lots, 100 lots, 2 lots, 2.5 lots? It depends, right? But based on the lot that you're using, you're going to be able to know that, okay, well, each pip that this currency moves, I'm making $200 or I'm making 75 cents. So that way, when you're going to be looking at prices, and I'm going to pull something up here. Let's say you're looking at USD CAD, and again, we'll look over charting soon. You'll know that, okay, well, look, if I'm doing 1 lot, I'm making $10 per pip. You know that if the price goes, let's say from here all the way up to, or let's say from where it's at now, 33408, and it goes to, I don't know, let's say 628. Well, you can calculate that the difference between those two prices is 22 pips. So you'll be able to say, okay, well, 22 pips times, $10 per pip, I'm making $220 if it goes from here to here. And because of this, you'll be able to, calculate how much profits you can make, or how much you're willing to lose. And we'll be able to use that for other calculations as well that we're going to get to later on. But, this is the calculation. Now, a way to do this is very easy. There's a simple formula to calculate this. And the pip value, you can, conclude that it would be the lots, how many lots you're using, times 10. So that's the simple version of the calculation. So if you're trading whatever you're trading, you can say, well, okay, if I'm trading one lot, well, one lot times $10 is going to give me $10. That's the pip value. If you're trading, like we said here, 0.1 lots, well, you would do 0.1 times $10, and then this gives you $1, right? The same calculation that we came earlier with. If you were trading 0.01 lots, you do that times 10, and that gives you the 10 cents we calculated earlier here, right? So this is a simplification of the formula, so you can just use that if you want. But later on, I will be giving you an Excel sheet that does all of these calculations for you. But I still want you to learn them. I still want you in the beginning to use a calculator and to test it out. Now we're just looking over all these, terms, but we're going to be using all of them at one point later on in the course. So don't be overwhelmed. And I'll see you guys in the next lecture. Leverage is going to be another term that you want to be familiar with, because trading Forex cannot be done without leverage. Okay. So what leverage is funds that your broker loans you. Okay. So your broker, whoever you're transacting through, is going to loan you these funds so you're able to transact with more money. Why? Because in the foreign exchange market, as you've seen, movements are very small. So for you to make any type of considerable profit or even loss, you have to trade big. Okay. And unless you have big capital, then it's not going to be worth it, which we've talked about. You're not going to buy for $100 worth and expect to make money. It won't work. So you need to borrow huge funds from your broker, trade with that, so your trades have bigger impact. So brokers can loan you huge amounts, okay? They can loan you up to 1,000 times your money, which is crazy, right? You don't get that in stocks. You don't get that in other markets, just in the FX world that you have such high leverage. Now, it's not because you have access to 1,000 times your money that you should get that. Different brokers are going to give you different types of leverage, but we'll talk about more of that later. For now, what you need to understand is when your broker tells you, and when we go to look at brokers, you'll see that each broker has a different leverage number that they'll give you. This is how you read it. When you see leverage 1-to-1, that means you're not getting anything extra. Okay. It's your own capital, basically, which no Forex broker gives you that. Okay. What would 1-to-1 mean? It means that your margin requirement, margin is how much money you have to put in to get the amount that you're going to trade. Let's say you have, you want to trade for $100,000. Well, if the margin is 20%, that means you have to put up $20,000 of that $100,000. So it's the margin required to trade all that capital. In this case, the margin requirement is going to be 100% because you're not getting any help. So if you wanted to buy one lot, you would need to put up $100,000, right? Depending what the base currency is. Now, if you get 2-to-1 leverage, what this means is that we're giving you one extra for each one that you're putting in, okay? In this case, your margin requirement is going to be 50%. So you need to put 50% of the money, the broker puts the other 50%. And in this case, buying one lot would require you to put in $50,000 because they're putting in the other $50,000. Now, if you were trading stocks, the maximum leverage they would give you would be somewhere around here. So with stocks, if you have something that's very risky, they don't give you any leverage. It's 1-to-1. If it's, okay, safe, they give you 2-to-1 leverage. Now, if it's very, very, very safe, they'll give you like somewhere around the 3-to-1 leverage, okay? But that's it. It doesn't go over that. But you see here that with FX, the leverage is crazy that you can get. So then if you can get 10-to-1 leverage, then you only need to put 10% of the margin requirement, meaning for a $100,000 position, you only have to put in 10K. 50-to-1, which, you know, any broker in FX is going to give you at least that. Well, you only have to put 2%. So you can literally put $2,000 in and trade $100,000 worth of a position, which is huge. Okay. You can get 100-to-1, which in this case, you put 1% of the capital, requiring you to put $1,000 for a $100,000 lot. You can get 200-to-1, which a lot of brokers have that as well. Now you have some crazy brokers who give you like crazy leverages, which we'll talk more about that later. But in this case, you can get 1,000-to-1, which it's not because you can get it that you should use it. When we talk about risk management, we'll talk about this specifically. But in this case, you will only have to put 0.1% and the broker will give you the other 99.9% to buy that position. So for a $100,000 position, you only need to put $100 in. And for this to make sense, imagine this. I'll go here on Trading View real quick. Just bring it up here. Here we go. And if we were looking at the same currency here, USD CAD, if you put up $100 and use 1,000-to-1 leverage, meaning you get $100,000 so you can buy one lot, we've already talked that one lot in this case would make you $10 per pip. So every pip that this moves, right, moves by a pip, you make $10. So in this case, if you would have, let's say, bought it here at 13350 and this currency goes up to 1340, okay, then you would have made 50 pips. So with $100, you buy one lot, it goes up 50 pips. Well, you make 50 times 10, $500. But imagine you buy it and it goes down. All it would have to do is go down by 10 pips, right? Because if it goes down 10 pips, then you lost 10 pips times 10, which is $100, which is what you put into your broker initially, and you've lost 100% of your money, just like that. So if you lose all your money like that, your broker shuts down your account, you lost your $100, they get back the money they loaned you, the 99.9%, they take it back, right? So they're not really taking any risk on you. It's just you're taking the risk. And this we'll cover in the risk management section. But it's just to understand that leverage is a double-edged sword. A lot of newbies that come into the market, they're like, okay, well, I can get this much leverage. I want this broker because it gives me the most leverage. Well, you shouldn't use this much leverage. That's too high. You'll lose all your money. So you have to do proper risk management to know what type of leverage you want to use. But more importantly, you shouldn't choose your broker based on the leverage because you'll see that brokers who give you crazy leverages, they might not have your best interest at heart because it's too much risk. And this we'll cover more in the risk management course, but just to understand that you can get loaned huge amounts of money to trade your positions, but you have to be very careful because leverage is a double-edged sword. Short selling. So you've probably heard of that term before. What exactly is it? Short selling is something that you do when you borrow an asset that you don't have, because you want to sell it in the open market, because you expect its price to go down in value, and you think you'll be able to buy it back at a lower price, and then give it back to its owner. So the way it works, okay, is basically, let's say you have a product here. If you think it's going to go up, well, what you do is you just buy it, and when it goes up, you just sell it, and you make money. But what if you thought it was going to go down? Well, how can you sell it if you don't previously have it? Well, you can borrow it from somebody, right? So let's say you can borrow this thing from somebody and sell it on the open market. And when we do that, we call that shorting, right? And when it goes down in value, as you expect, well, you can buy it back. And when you buy it back, then you can give it back to its owner. And you would have made the proceeds in between. For example, if you sold this here at 136 and then it went down to 131 and you buy it again, you give it back to its owner, you just made the difference. You made the 5 cents difference. let's have a simpler example here. Okay. Let's say you know that there is the iPhone 11 that's coming out in a few weeks. And you know that because the new iPhone is coming out, the price of the old iPhones is going to drop in value. Now, you don't have an iPhone, but you think you can make money because of this drop in value in the old iPhones. So what you do is you go to your friend's house. You know he has an iPhone 10 and he's sleeping. You talk to their family. You talk to their dad. You're like, hey, you know what? Can I borrow this iPhone 10? Okay. And I promise I'm going to give it back to you tomorrow. Okay. I'll bring it back tomorrow. You know, your son's not going to know about it. So you get the iPhone 10. You go online, you go to, I don't know, an online selling store, eBay or something, and you sell it there. And the price for iPhone 10s is, I don't know, $700. Okay. So you make $700. Now, the next day in the morning early, the iPhone 11 comes out. Now, the iPhone 11 comes out and it's the price of the iPhone 11. And it doesn't matter. It's like 14. They're super expensive now. Anyways, 1,400. Now, because the iPhone 11 came out, the iPhone 10, its price dropped in value, and now the going price on eBay and all these other stores are 500. So you go back there and you buy this iPhone at $500. So initially you received $700, okay, when you sold it, and now you're buying another one, the exact same thing, for $500, right? So in the end, you have $200 and you still have the same iPhone, right? You still have the same iPhone. So what you do is you bring back the iPhone to your friend's house and you give him back the iPhone. Now your friend's dad takes the iPhone, puts it back in his son's pocket. Your friend never knew that you borrowed it at all, and you made $200 in profit. That's how shorting works. You borrow funds from your broker. So you don't actually borrow these things from your friends. You borrow it from the broker, right? And you're able to transact and bet that something is going to go down or go up, even though you don't even have that thing, because you're borrowing it from your broker and you're able to generate money because of that. So if we look at something, again, let's just bring back our example here on USD CAD. If you bought this at, let's say here, this price, which is 1.28, when you're buying this currency, what you're actually expecting is that the base currency, in this case USD, is going to gain in value. It's going to be stronger. And because it's going to be stronger, well, it will be able to give you more Canadian dollars in the future. It's going to be worth more Canadian. So you either think that the US dollar is going to strengthen or that the Canadian dollar is going to weaken. Because if the Canadian dollar weakens, well, you would need more Canadian dollars to give you the same $1 in US. Or if the US strengthens, you're still going to need more Canadian dollars to get you $1 US. So that's when you're buying it. Now, when you're shorting it, because you can buy here and sell here, and this is, let's say, 136, this is 128. So that's 8 cents difference, which is 800 pips. It's ridiculously huge. But that would be if you're buying it. Now, if you're shorting it, well, then you're actually selling the USD and buying the CAD. So you're expecting the USD to lose in value, okay? So your base currency to lose in value, to not be as strong as it was. And because of that, it will get you back less Canadian dollars. Or you can think of it as you think that the Canadian dollar will be stronger. And because it'll be stronger, it'll get you a US dollar is going to be worth less Canadian dollars, right? Because the Canadian dollar is stronger. So that should require less of it to get $1 of US. All of this is going to make sense as you trade and you practice, but it's just an understanding of this would be buying and selling. But then if you want to bet that it's going to drop in value, you would have to short here and then buy back at a lower price. And that's really what shorting is.
Hey guys, this is a very important video that I wanted to make to warn you about something that's been going on for the past few months. For the past few months, there's been a lot of fake accounts, fake profiles of me online that are trying to scam individuals. So I want you to be extremely careful if you are following me online. Now, this is happening in two places, on Instagram and on YouTube. First, I'm going to talk about Instagram. If you're following me on Instagram, these are the only two profiles I have. These are the two only accounts. My personal account, where I post most often, and my company accounts. Now, I do recommend you follow me there because I do post about current positions I have and things that are happening in the moment. But if you do go and try to follow me, you're going to notice that there's a bunch of other people that are using my name online. Now, they're going to have the same pictures as me. They're going to post the same stories as me, same comments, same everything. The only way you can know if it's my account or if it's somebody impersonating me is the handle of that account. These are my only two accounts. Other accounts, even though everything else is going to be similar, the handle, the name is going to be slightly different. There might be an extra L at the end, an extra 7, an extra underscore, an extra dot, something very small that you might not notice. So you got to be careful to not follow an imposter, somebody who's pretending to be me that is trying to scam you out of your money. Now, even if you follow the right account, even if you follow one of my official accounts, what these people do is they monitor everybody who follows me and they message them directly. So if you follow me on Instagram, somebody else is going to message you pretending to be me. Now, you might fall for this. A lot of people don't, but some people do. And it kind of makes sense because you follow me and then all of a sudden you get a message from somebody who has my picture, who has my name, who has everything that looks like me. It's only the account that looks slightly different. You might not notice that. Now, these people aren't me. I'm going to tell you how to figure out if there's a fake profile of me or if you're actually talking with me. Well, first of all, number one, I will never message you first. So if anybody ever messages you first with my name, it's a fake account. Please report that account. I will never, ever, under any circumstances, message you first. Even if you follow me, even if you comment on my picture, for any reason, I'm not going to do it. Number two, these people are going to talk to you and they're going to try and sell you something, right? The first thing they do is they try to get you off of Instagram. They're going to ask you to give them their WhatsApp number or they're going to give you their WhatsApp number. Again, number two is I never give out my phone number. I never give out my phone number for any reason. When there's something very important, I usually do this by email, but most often I actually have somebody who answers my emails. So again, I do not give my phone number. If somebody gives you or tries to take your phone number, it's a scam account. Report that account right away. Number three, these people will try to sell you something. They'll try and sell you mentorship. They'll try and sell you an investment account, a trading account, a robot. Every time it's something different. I don't have any of these things to sell. Not one of them. Okay? Nothing. There's nothing for me to sell you. The only things that I have that I sell online are some online courses on Udemy, and those are available on Udemy's website directly. So if somebody messages you about selling you anything with my name, it's not me. Report them right away. But number four, these people will usually ask you to make the payment for whatever they're selling you via Bitcoin. So they'll ask you to send them Bitcoin. Don't ever do that. Don't send Bitcoin to anybody online. If you ever send Bitcoin, you're never going to see that money again. So this is a warning message that I wanted to give you because if you are following me, they're literally messaging every single one of my followers. So just be extremely careful. Again, I don't have anything else to sell other than the things on Udemy, and that's done through Udemy directly. I will never message you first. I'll never ask for your phone number or, ask you for Bitcoin or anything like that. If anybody messages you with my name, please report them right away. Actually, before reporting them, if you want to mess with them for a bit, that would actually be really nice because maybe if everybody messes with them for a bit and wastes their time, they're going to stop doing that. I don't know, but I wanted to warn you about that. Now, this isn't only happening on Instagram. This is also happening on YouTube. And YouTube, it's very tricky. So if you go on my YouTube channel and you follow me there, in the comment section, what these people will do is they'll create a fake account that looks exactly like our account. And they're going to comment their phone number under different messages. And I can understand people falling for that because let's say you're watching one of my videos on YouTube. You go down in the comment section and you see a comment with the same picture as our channel picture, with the same name as our channel name, and it posts their phone number, their WhatsApp number. It says, contact me. This isn't us. These people are creating fake YouTube channels, putting the same name and same profile picture, and putting their phone number. So people see that phone number, and they think it's us. And I understand you can think it's us because, again, same picture, same name. But that isn't us, and they will try to scam you. So be careful even on YouTube. This isn't something that's been happening just to me. It's happening to a lot of Udemy instructors. It's happening to a lot of YouTubers. Stephen Graham actually made a video about this. I'm going to actually link it here or put it down in the comment section, where he shows how it's happening under his channel.
I'm talking about the comment section. What used to be a place for healthy discussion, back and forth banter, and honest criticism has now turned into a playground for scam artists who create a web of fake conversations for the sole purpose of trapping unsuspecting victims who believe that they could earn money using the techniques of insert name here.
So this is something that's very widespread. It's happening to everybody, everybody who isn't too popular, a little bit popular, who has a following, who talks about finance or different products. There's people who create fake accounts of that person and try to scam his following. So I want to post this video everywhere. I want to make sure that all my community knows about this and to be very careful, because even though 99% of people don't fall for this, there's that 1% that they just don't notice and it happens to them. So please guys, be extremely careful. I'm never going to message you first. If somebody messages you with my name, please report them right away. Don't send Bitcoins to anybody online for any reason whatsoever. And I'll see you very soon.
So we've talked about the history of money. We've talked about the Forex market, the quotation system. We've talked about terminology, pips, lots, all of that stuff. Now it's time to look at brokers so you can see which broker you want to open an account with, so we can start playing around with things. So what exactly is a broker? We've talked about that. A broker is going to be the entity that facilitates the execution of your order, right? And what is an order? An order is just your instruction to buy or sell something. So whenever you're going to be buying or selling something, you're going to be sending an order, and there's different order types, which we're going to be looking at later when we look at the platforms. Yeah, that's what your broker's job is to do, is to receive your order and execute it for you. Now, how do you choose a broker? Because there's hundreds and there's too many brokers out there, okay? Well, first of all, what do you want in a broker, okay? Number one thing is you want your broker to be regulated. What that means is you want a broker that has oversight. And the more the regulation is, the better, right? Some brokers are not regulated at all, and they can do some pretty shady stuff, and they can go bust at any time, okay? So you don't want that. Again, you also want transparency. So you want a broker that tells you what's going on. You want alignment of interest. Some brokers are notorious for, bad practices where they give you huge amounts of leverage because they just want you to blow your account as fast as possible for them to make the fees because they're trading against you, right? They're taking opposite positions. So you want to make sure that your interests are somewhat aligned. Some others, situations, brokers do take the other side of your trade, but they hedge themselves. So they're not really doing that. It's something that's important as well. Low fees, obviously extremely important. Good leverage, obviously important. Now, you don't want 1,000 to 1 leverage. You don't want the max out there, but you want something that's okay leverage for you to do your trading. You want a good platform, also very important. So most brokers actually offer, MetaTrader 4 and, the common platform there, which is the one we're going to be using. But you need that. And then support. Support is very important because if you're having any issue, if you can get good support, that's really helpful. Now, all of that being said, what I'm going to be doing in the next lecture, I'm going to be showing you in the next few lectures, showing you which broker I would recommend. But I'm also going to be giving you a shareable Google Sheet where you can recommend brokers. I can take a look at them to see if they're good or not, and I can add them to the list. I'll talk about that later, because not all brokers are going to work for all countries. Some do not accept different countries, and because of that, this sheet is going to be helpful to you so you can see what other people are using and which one could be best. But I'm talking about that later. So these are the things that you want to look for in a broker. So when we're talking about brokers, you're going to see that there's two types of brokers. There's A-book brokers and there's B-book brokers. So what is an A-book and a B-book? An A-book is the order book that has the major liquidity providers. Okay, so you see all the buyers and sellers from other liquidity providers like the big banks and all of these other providers that you can buy and sell FX from. Okay, when a broker is using this book, so the A book, he is sending your order to be executed with one of those liquidity providers. So it's like the stock market in type of a way. There's orders from other people, there's an order book, and your broker just reroutes your order to buy or sell from one of these other, venues. This is the order book used by ECN brokers, which, this is more recent. We've seen ECN brokers more recent than before. It's a more recent occurrence that we see ECN brokers. And usually what they're going to do is there's going to be this order book. They're going to reroute your order and they're going to charge a commission because of doing that. Exactly in the same way that stockbrokers do. Now, the most common one that you're going to find is going to be B-book brokers, which these ones, their order book is an in-house order book. The buys and sells, they're not getting them from other liquidity provider. They actually generate these orders. So this order book. So when a broker is using this order book, he is taking the other side of your trade, right? Meaning if you're buying, he's selling it to you. He's taking the opposite side. He's betting the opposite direction of what you're betting. Now, for him to make money, he has a spread, right? The difference between the bid and ask, which we talked about. And this is how he makes his money, because you might buy, so he sells to you, but somebody else is simultaneously selling, so he buys from them at a lower price. And he is making the spread, the difference between the bid and ask. This is the order book used by market makers. So this is why we call it market makers, because these brokers are just making a market for this currency. They're buying it from people who want to sell it, and they're selling it right away to people who want to buy it. And they keep buying at the bid and selling at the ask and making money from the spread. Now, some of these brokers will hedge their positions, meaning if everybody is selling USD and then they have too much USD, well, they might go ahead and sell it to one of those liquidity providers, right? To eliminate the risk that actually USD loses in value and then they lose money. So they have risk management techniques, but in the end, they are taking the other side of the trade, which I kind of don't like too much, because that means that, your interests are not aligned. They would want they would want the position to go against what the majority of their client wanted to go. But if they're hedging their positions, that's eliminated. So, a lot of them also hedge their positions. It's just a way for them to control their risk. So if you have the option of two different types of brokers, the A-book broker that just charges you a commission would be best. But then if you have a B-book broker that hedges their position, is not bad too. But then a B-book broker that has a bad reputation, that, has wide spreads to make the most amount of money on you, gives you huge leverage, you don't want to go with something like that. Okay, so we've said that you have brokers that use an A-book and brokers that use a B-book. Now, if you have the option between two brokers and they're as good as each other in terms of reputation, trustworthiness, all of that stuff, you would prefer to take a broker that uses a A-book. Why? Because there's no true conflict of interest. There might be, but a little bit less. So if you're looking at a broker like IC Markets, okay, this would be a true ECN broker. And you see here, they say they're an ECN broker, so you know that they're using a A-book. And because of that, you see that the spread that they have is often zero. And this is a very high leverage. You shouldn't need as much, but they offer that to you. But their spreads is very small. Now, why is their spread small? Because they're not artificially creating a large spread to make commission. They just don't charge you a spread. They route your orders to, a lot of liquidity providers. So you send your orders, and where there is these orders, there's other orders from banks, HFTs, dark pools, and you can execute against them. And they charge you a small commission. So that's how they make their money, right? Now, I'm going to talk about this broker and the broker I recommend in the next lecture, but this would be an ECN broker. Now, you can have something else, like let's say Oanda, which is not a ECN broker, okay? So they actually have a wider spread. And you see, if I look at USD CAD, so if I want to sell this, I can sell it at 1.33479. But if I want to buy it, I'll have to buy it at 1.33496. So I can, if I buy and I sell right away, I'll be losing a bit of money. And how much would I be losing? 0.00017. So that's 1.7 pips. And you remember that if we're trading one lot, 1 pip would be $10. So 1.7 pips would be $17 on a one lot contract. Okay. Well, which you're not going to be starting to trade by one lot. You're going to be starting to trade at the minimum quantity, which is 0.01. But, you know, you can see that the commission plays a fact. Now, the only difference, you are going to be paying commissions regardless of where you're trading. Okay. The only difference is with a broker like this one that doesn't use a book, the spreads will vary based on the volatility. Because when he's buying from you or selling to you, most often what they're going to do is they're going to hedge their position. They're going to go into other liquidity providers and get that position at a better cost to them. And the difference between what they sold it at to you and what they were able to buy it at is going to be their commission, their profits. The other ECN brokers, they just don't do that process and they send your orders right away to those liquidity providers. You get the fill and it just charges the commission for doing that thing for you. So in the end, it kind of, it's almost the same thing in terms of how much you're going to end up paying. But with these, some brokers, if they're not reputable, they will highly inflate the spread. And what they would want is they would want you to lose because they actually are taking the opposite side and they're not always hedging that position. They're not going out and buying it. So that's where there's conflict of interest. So when I'm saying if you have an option, take an ECN broker, not only if it has a really good reputation, because even with ECN brokers, there's a lot of bad practices that they can do. They can send your orders to HFTs that don't actually get you the best price. And by the time you get filled, you get a worse price than you would have gotten with one of these other brokers that has a better reputation. So I would say, you know, being with a broker that's very highly regulated and has a very good reputation is very important. And then if those things are equivalent, then if you have one that's true ECN, that would be slightly better than one like that, but only if, you know, regulation and trustworthiness are on the same page. Now, in the next lecture, I'll say which broker I recommend that you should start using. Okay, so which broker do I recommend that you use? So I'm going to give you two options here. In the next lecture, I'm going to add a shareable Google Sheet where you can see other resources as well or other options. So the first one I'm going to recommend is IC Markets. IC Markets is actually one that I've used before. It's based in Australia. It's very, very highly regulated. And they have, you know, a lot of amazing things. So high leverage, you shouldn't use all of that. It's a true ECN broker, which, you know, we like. Order execution, ultra fast. So 40 milliseconds is basically the time from the moment you send your order to the moment it gets executed. It's 40 milliseconds. To put that into perspective, there's 1,000 milliseconds in a second. For your eyes to see, you know, an information on your screen, it takes 200 milliseconds. So this is pretty quick. You know, it's not HFT level, but it's pretty quick. Institutional grade liquidity. So they have huge order books that they can access. So you can get filled very quickly. What else? They have other things you can trade, indices, bonds, stocks, commodities. So you can trade other things through them as well. What else here? Okay. Powerful trading terminals. You can work on any platform, but that's all of these brokers are going to have that. MetaTrader 4, which is the most popular platform. And then they're all going to have MetaTrader 5 as well, but they're all going to have their own trading platform. Now, what's really nice about this one is they have a lot of options for you to fund your account. Okay. And they have pretty fast and quick withdrawals. Now, I used to use this one before, but they started rejecting, or from I guess about a year and a half ago, maybe, I can't remember exactly, they stopped accepting Canadian residents. So since I live in Canada, I'm not allowed to use them, or maybe it was a bit less than that. It was a bit less, maybe less than a year ago. They stopped accepting Canadian residents. So I had to pull out my money and stop using them, as well as every other Canadian. And I think it was a regulation thing where our regulators there was something with the regulation. But just to say, it's not all brokers are going to accept people from all countries. Okay. So for example, IC Market, I can't use anymore, but you might be able to use it. So what you have to do is just Google it. Can I use IC Markets for, I don't know, wherever you're living, Japan? Can I use IC Markets? Does IC Market accept residents of Japan? And you'll see if you can get with them, open an account. If you can't, no stress. There's a bunch of other brokers. So now the one that I'm using is Oanda. So Oanda, and I'll open it on another page here. Very, very reputable broker. Okay. They offer a little bit less leverage. So it's 50-1. Okay. But again, when you're starting off, you don't want high leverage either, because your objective is not high risk. It's to be low risk in the beginning, because that's when you're learning. So we want as least risk as possible. So it's perfect. They're not a book broker, they're a B-book broker, but they offer tight spreads. So their spreads are tight. The execution is good. I've had good, experience with them. They have a fix and REST API. Those are APIs if you're automating something, if you're doing something automated, which I'll be making courses on that at one point. You also have access to CFDs, so trading other products, you can do that. You can transfer funds through your bank account or through PayPal. And the thing I like the most about them is their customer support. Okay, if there's anything, you get a dedicated person that's responsible for your account. As soon as you open your account, they talk to you, they email you, they call you, they set everything up. If there's any problem, you give them a call, you have their number, so you're always talking with the same person, and they get everything set up for you. And that's regardless of the amount of money you're starting with. Even when you're starting with a small amount of money, they're very good. So this one works if you're living in Canada, and then probably with these two, regardless of where you're living, you would be able to open an account with one of them. In the next lecture, I'll have some more resources in case one of these doesn't work for you, or in case you just want something completely different. So with most of my courses, what I do is I create a shareable Google Sheet. Now, the purpose of this sheet is to have resources for the product that you're trading. So for our case, this sheet is for Forex resources. It's going to have a section for brokers, calendars, news providers, charting, and other resources. Now, I've done something similar for stocks. In the beginning, when I start the sheet, there's nothing on it, because this is something that students collaborate together to fill it out. So the way this works is, if you find a broker, or you know of a broker that's not on the list here, you can just, when you open the sheet, it's going to look like this. You can right click and add a comment and tell me, hey Mo, what do you think of the broker, whatever, FXCM, or you can tell me, I use FXCM and they are great. I think you should add them. Okay. And then comment, and I'm going to get your comment. So this sheet, you can add comments to it. You cannot edit what's already here. You can just comment things in. Now, you're going to see that here for Oanda, I've also added that it works for Canada, because I live in Canada, I use it. Now, if you live in Japan and you're able to open with Oanda, just put me a comment here. Say, hey, I use Oanda in Japan. Please add Japan, right? And likewise for IC Markets. If you're living in a country and you figure out that it works there, add it. And this way, what happens is, on my Google Sheet, my version here that I have, I get your comments. And I can see that, somebody said, hey, I use Oanda in Japan, please add it. I can comment, sure, thank you. I'll reply. I'll resolve this, it'll go away. And I'll add here, Japan. If you're talking to me about FXCM, and I check it out and I find that FXCM is a good broker, I'll add FXCM over here, and I'll add it, and I'll add all the information. So other students can gain from that. And the reason why I do this is because I have students that are from 150 different countries. So I don't usually know which broker which works for which country, which calendars are good for which country. So even here, I might add a section for countries, right? Or whatever. So which other resources works for which country, I wouldn't be able to know for all the countries. So that's why I need your help in filling out some of the resources. So if you find that you use something that's not there that you would like other students to know about, add it in. And as time progresses, this sheet is going to be really filled up. And if I show you the one, let's say that I have for stocks, well, this is the Google sheet for stocks that I have for my other course. When I started this sheet, there was nothing on it. And if you look now, it's filled up, right? And this is just for US and then Canada. And for this sheet, I have so many countries. And when we started it, there was nothing on it. So this is a very good tool. And the other reason I like it is because you can have this sheet, you can save it, you can send it to your friends. And every time I update something on it, it'll update for everybody, right? So as time passes in a year and 2 years, if there's something new I added there, you have access to it. So keep it handy. It'll be filled up. And, send me any recommendations you have that you think are going to be useful for other students as well. Okay, so what I want you to do now is go ahead and decide on which broker you want to use and open an account with one of them. Now, when you go to open your account, you're going to have the option to open a live account or just a practice account. Now, I recommend you start with a practice account, so it's a simulation account. You could also open a live account, but just to use the simulator if you want. Now, I recommend you do this right now because it sometimes takes a while for them to approve your account. So a few days to up to a week maybe to get your account approved. You're going to have to send some documentations and stuff like that based on which country you live in, proof of residence, all of that stuff. And then your account will be open. Now, the difference between a live account and a simulation account is the only difference is in the simulation account, you're not actually trading with real money. So it's virtual money, it's simulated money. So it's just pretend money, right? So you're buying and selling and you're making profits, but it's all fake money. It's important that you start with a simulation account because you're going to be making a bunch of mistakes in the beginning. You're learning, right? It's like if you're learning to play soccer, you're not going to go on the field on your first day. You're going to be practicing and playing with other people and getting better. And then when you're ready, you're going to go on the field. So you have to start with a practice account. Okay. So make sure you start with a practice account. And later on, once we go over trading and all of that stuff, only when you're making profits, and we're going to have a sheet to record your historical trades, only when you see that you're profitable and you're confident, then you go to a live account. And even when you go to a live account, you're going to start off small. To make sure you're able to reproduce the same results that you did in the simulation account in the live account, because when you go live, then psychology kicks in, emotions kick in, a bunch of things, even trade executions are sometimes a bit different. So even when you go live with a small amount of money, you make sure you're generating good results, good profits, and only then do you start scaling up and put bigger amounts in. And this is the professional way of doing it, right? Even me, you see here, I have this account here. This is my Mo test account 4. This is one of my 4th. I have practice account, tests accounts, different brokers. Because whenever I test something new, a new strategy and something new that I'm doing, I test that out first, even though I've been doing this for like 10 years now. So, if you're starting off, then for sure you should start off with a practice account. Make sure you do that. So I've got you to look at different brokers and to choose a broker for yourself to open an account with. Now, before jumping into the different platforms and sending orders and whatnot, I want us to look at the different ways of analysis, because this is going to be the foundation that you're going to be using to try and forecast which direction a specific currency is going to go. Now, you have 2 ways of analyzing a currency. One is technical analysis, and the second one is called fundamental analysis. Now, what is the difference? First of all, what is technical analysis? Technical analysis is going to be the discipline that uses price and volume to identify trading opportunities. So whenever you're looking at a chart like this, which we're going to be getting into that in the next lecture, you're going to be using technical analysis because you're looking at prices and volume in order to predict which direction it's going to go. So you can use anything that has to do with the prices, indicators, a bunch of other things that we're going to be looking at, and volume to try and predict which direction this is going to go. That's the only thing you're going to be looking at. So you use technical analysis basically to have a systematic way of finding high probability entries and exits to generate profits out of this market. Now, what is fundamental analysis? Everything else. So basically everything else that doesn't have to do with price and volume is part of fundamental analysis. So you can look at the politics, you can look at interest rates, employment, GDP, trade deficits, printing money, anything that's not price and volume could be fundamental analysis. So you're looking at fundamental criteria that have an impact on the supply and demand for a specific currency. The way I like to compare technical analysis and fundamental analysis is by looking at real estate. If you're looking to buy a property, well, are you going to look at fundamentals or technicals? Well, it depends. It depends how long you're expecting to hold that product for, that house for. If you want to buy a house and you want to hold it for, 20, 30 years, well, you're going to look at fundamentals. Why? Because you're holding it for long term. So you want to make sure that it has a solid foundation. You want to make sure that it's isolated. So during winter, heat doesn't just dissipate. You might want to make sure that there's not going to be a bridge built near your house in the near future. You want to make sure it's in a great neighborhood. All of that stuff, right? You don't care too much about, current price, how much the house next door just sold or things like that, because you're holding it for, 30 years. So you expect its value to be based on these fundamental things that you looked at. Now, you might also want to look at how much you can rent it for, all of that stuff. Now, if you plan on just flipping a house, buying it and selling it, then you're not going to look too much about fundamentals. You don't care if in 10 years there's going to be a bridge. You don't care about all of these little things. You don't care about the isolation. You want to buy it and sell it the next week. What you truly care about is technicals. So what is the supply and demand right now? So how many houses transacted, how many purchases and liquidations happened in the last month and the last week? How much houses nearby in the same neighborhood sold at, and how frequent that is? That way you can have an idea of how much you can sell it at very soon. So you can buy and flip the house. It's the same thing in all types of trading. When you're looking at something for long term, you have to keep in mind about the fundamentals, because that's what's truly going to matter in the long run. But if you're trading something in the short term, then there's not enough time for those fundamentals to be valued correctly. What you want to look at is technicals. Now, that doesn't mean that if you're trading short term, you should just disregard fundamentals. It just means that you're going to look at it in a different way. So what I suggest that you do, and this is how I and most traders have learned, is to basically start off with technicals. And the reason why is because technicals are way easier in the Forex market. Okay, so you start off by technicals, looking at different technical indicators to give you a entry and exit points. Now, while you're doing that, you also have to look at fundamentals to avoid big events that might impact the currency very strongly. Now, as you're doing that, fundamentals is going to be something that you're going to learn as you go. Why? Because fundamentals is so broad and it's not a set function that you can just follow. There's so many things that can happen and that interact with one another. To really understand fundamentals for Forex, you need to do several macroeconomic classes. So it's a long period of study to really understand how these things impact one another. And the best way to do that is, as you're trading, read the news, see how different events impact your currency, and you're going to learn more and more and more about fundamental analysis and be able to use that to have longer term directional plays on different currencies and know exactly when a specific event happens, how that will affect your currency. So when it happens again in the future, you're able to capitalize on it. I myself still today learn a lot about fundamental analysis as I see more and more types of events. And some types of events I've seen so many times that I trade on them in a very confident way. So in this course, technical analysis is going to take the larger portion of this section, but we're also going to look at fundamental analysis in a way to look at what should we avoid so we do not get hit while there's a specific type of event. And then as you go along, as you go through your career of trading, you're going to learn more and more about fundamental analysis. So it's finally time to start looking at charts, which is what technical analysis is, right? Some people call technical analysis the study of charts, which is what it is. Now, that being said, what type of charting software are we going to use? The one I'm going to recommend right now is going to be TradingView. TradingView is the most popular charting software in the world right now. Now, that being said, depending on which trading platform you're going to decide to use, so example, if you decide to use MetaTrader 4 to enter and exit your positions, you can do your charting right away in that platform. And I am going to show you also how to do your charting through MetaTrader 4. But you might decide to use another trading platform. You might decide to use MetaTrader 5 or CTrader or whichever platform that your broker offers you as well. Well, for that reason, I want to show you also how to use TradingView, since TradingView anybody can use. And also everything that you're going to be able to do through the charting here, you can do in any other charting software. Another reason why I like TradingView is because you can do the charting for everything else within TradingView. So I do my charting for stocks, for cryptocurrencies, and for Forex through TradingView, which you can't do through MetaTrader 4 because MetaTrader 4 is just for currencies. MetaTrader 5 has more options. But that being said, when you're learning, it's very good to learn on TradingView. You can also do the charting on your platform as well, and you can see which one you like best. And in this course, I'm going to be showing you TradingView, and I'll also go over MetaTrader 4 later on in the course once we get into the trading platform. That being said, TradingView has a lot of different things that you're going to like as well. When you go on their main page, there's a lot of things that you can see here. You can follow people, there's top authors that you can follow, you can look at their analysis, you can comment, you can read other people's comment. So it's a very good place for you to learn. There's calendars in here, there's a bunch of things. There's screeners, Forex screeners, crypto screeners, there's a bunch of things, and then you have your charting. So if I go on my charts here, okay, you're going to see one thing. Top left, you're going to be able to put the currency that you want to look at. Example, if I want to look at USD CAD. When I put USD CAD, you're going to see it gives me, well, first of all, I can select what am I looking at? I'm looking at Forex. Well, in Forex, I have 4 different things here. Why? Because they're coming from different brokers. So here I'll be getting the prices from FXCM, here from Oanda, here from Forex.com. So I want to get prices from Oanda. So I click on Oanda, I have it here. Right? Let me just change it. If I go back, USD CAD, I want the prices on Oanda here. So I have my charting that's coming directly from the broker Oanda. Now, if your broker isn't there, it's okay. You can select another broker. The prices will vary between brokers by maybe 1.5 pip, not more than that. So it doesn't really matter too much. But if your broker is listed on there, select that broker. And you can look at your chart here. Now, the really nice thing here with TradingView is I can create different lists. So example, I have lists for cryptos, for stocks, for US, for Canada, and I have one for FX. I can go in, let me go in pairs. Here I have some cryptocurrencies. I go FX, I have all of these. And I can just look at charts by clicking on them very quickly. And you can add different currencies here. So if I remove USD CAD, if it wasn't there, you can have your list here and add different currencies. I can put USD CAD and add it here. Then it becomes very easy to have multiple currencies. You can also click here on layout and have different layouts. Example, if you want to look at 4 currencies simultaneously, I can click on this, select which currency I want to have where, and then look at multiple currencies simultaneously, right? Which is super nice. Now, there's a bunch of other things that you can do, which I don't want to jump into right away because I want us to look at the basic charting. but then we'll look at some other things that you can do that might be very helpful to you. So that being said, if you don't have an account with TradingView already, make sure you go right now and open an account with them. There are several subscription packages. The first one is free, so you can just use that one if you want. I have the pro version because I'm using a bunch of the other bells and whistles, but start off with the free version only if you start wanting to use something and TradingView actually tells you, hey, sorry, this is only available for pro or premium users, then start considering upgrading, but start with the free version right now and play around with it a bit as we look into the next lectures. In this lecture, we're going to look at candles, candlestick charts, and line charts. Now, whenever I pull up a chart, or whenever you see charts online, you see these things here that are composed of some green things and some red things. Well, what are these things? This is what we call candles. And all of these candles compose a candlestick chart. So it's a chart of candles. Now, what is each of these candles? Well, a candle is basically a representation of the prices in a given period. So let's say I want to look at one day, the period of one day, today. Well, I'm going to look at the candle. And the candle is going to give me the first trade of the day. So the first execution of the day that happened, the price of that. So if the day we started at $10, let's say, it would have a $10 opening price. Now, throughout this one period, this one day, prices will fluctuate. Maybe this currency is going to go up, so it's going to be 10 for, it's going to go up to 12 for one, and then it's going to go down to 9 for one, and then come back to 10 for one, and then go up again. What this candle is going to show me, it's going to show me the opening, then it's going to show me the low that it had throughout this day, the high, and then the close. And this is going to be a candle. Now, if the price closed at the end of the day higher than it was in the beginning of the day, it's going to be a green candle because it's going to tell me that prices went up for that period, in this case for a day, right? Now, if the price had closed down, we would have had a red candle because in a red candle, the close you see here is lower than the open. And then there's a high and there's a low. Now, the low and high are represented by wicks. These we call wicks or shadows. And those are basically candles. So if you have red candles, you know that prices went down for this period. If it's a green candle, it went up. So when I look at something like this, well, I can say, for example, that this is a daily chart that I'm looking at. So here you can see that I'm looking at daily. That means that each candle represents one day. I can look at this candle. This is today. Well, this candle would be yesterday. You see here, it says at the bottom, the dates. So this one was May 1st. The one before was April 19th. The one before, April 30th. The one before was April 29th. One before, April 26th, because there was the weekend, right? So if I look at yesterday's candle, I can see it's a green candle. So prices went up. So in the beginning of the day, the price was you can actually tell from here. There's the open, high, low, close. So when I go over a candle, I can see these numbers changing. I can know that here it opened at 1.33904. That was the opening price. Okay. And sometimes it's hard with the mouse to get it exactly if I'm looking at here, but if I pass it on it, you see it here. Okay. So 1.33904. The high was 1.34615. And then it closed at 1.34378. So at a higher price than it opened at. Now this is because I'm looking at a daily chart. Okay. And I can look at other days and be like, well, let me just zoom out here. Here there was a lot of consecutive red days. Okay. Here as well. Okay. And I can see that some days, you know, something might have happened this week because we had a lot of consecutive red days. What happened? You can look at things like that and try and analyze. Now, you might not always want to look at daily charts because maybe you want to intraday trade. You want to trade shorter period. You don't want to buy something here and hold it for 3 months. Maybe you want to buy something and sell it tomorrow or maybe in an hour. So you can select different chart length types. So for example, maybe I want to look at 1 hour charts. And then what happens is that each candle is going to represent an hour. Now look at this. If I'm looking at this chart now, each one of these candles is an hour. So I can see that this is today, May 1st at 6 p.m. This candle was an hour earlier, so at 5 p.m. This one was an hour earlier, so at 4 p.m. You can see that here at the bottom. Here we go, 4 p.m. And so it starts at 4 p.m. and it finished at 5 p.m. This candle was at 3 p.m. This candle was a bigger candle and it was at 2 p.m. So each candle is now a 1 hour candle. And then you can do your analysis because you're trading within an hour range. You can look at 15-minute candles. And in this situation, again, each candle is going to represent 15 minutes. So this one is at 6 p.m., but this one started at 5:45. This one at 5:30. This one at 5:15. So you can do different types of trading. You can do short-term trading or long-term trading. And based on if you want to do short-term or long-term, you're going to look at different time frames. So for me, I always look at the daily charts to get a global idea of the direction that we're going. But then if I'm doing day trading, so buying and selling within the same day, I like to look at 5 and 15-minute charts. If I'm looking to do a little bit longer than that, I would look at 1 hour charts. If I'm looking to do some swing trades where I'm holding for several days up to a few weeks, I'll look also at 4-hour charts. Now, that being said, those are the charts that we're going to be studying. Now, these are candlestick charts. And let me get back here to daily charts. Now, are you going to use this type of charts or other types of charts? Well, if I click here, you can see that there's a bunch of different types of charts, right? There's the candlestick chart, and then there's the line chart. Now, if I click on the line chart, you'll see that it doesn't have all this information because a line chart is basically a chart that has the close on each period. So it only connects these dots. Okay, it doesn't have the high, the low, and the open as well, so you can get a more clearer picture of what happened on that day as well. So it's way simpler. Now, will you use this? Not really. You'll use the candlesticks because the candlesticks give you the most information possible. Now, the only times we're going to use line charts is when we're comparing different currencies together, and then you might want to just look at the lines to be able to compare them. But other than that, we'll always, so 95% of the time, going to be using candlestick charts. Now, some people like to look at these other chart types. I haven't had any type of better prediction value using them, and I have always used this one. And most of the traders that have traded for me or that I have encountered in other trading shops only really use the candlestick types. There's a bunch of different informations out there, a bunch of different things, but a lot of these things don't add value to you trading and will just end up confusing you and giving you more information that is not needed, to be honest. So for me, stick with candlestick charts. It's more than sufficient for everything you're going to be needing to do. In this lecture, we're going to be looking at trends and trend lines. So what are trends? Trends is basically a trend. You've heard of that before, right? There's a trend. Everybody going in a specific direction, right? So it's the same thing in currencies. A trend is when a currency is going in a specific direction. Now, you can have a uptrend, which means the trend is going up. You can have a downtrend, which means it's going down, or a side trend, which means it's going sideways. Now, an uptrend is characterized by higher highs. So you see here, there's a high. The next higher is higher than that. And higher lows. So this low, you see that the next low is higher and the next low is higher. So when prices are going like this, that's an uptrend because each high is higher than the previous one and each low is higher than the previous one. Downtrend is you have lower lows and lower highs. So you have a currency that's going down and you see that each time there's a low, it's lower than the previous low. And the highs are lower than the previous highs. And side trend is basically where it's, equivalent. The highs are equal to each other and the lows are somewhat equal to each other. So we're trading in a range like this. So you might have realized or saw earlier that on my USD CAD, I had some lines here. Well, you see here, you can see that there's, some type of trend since September 2018, right? Now we're in May 2019, and there's this type of trend here. You can see that every time we have a high, and let's see if I can draw on here, or even a low, let's just look at the lows. Every time I have a low, okay, there's a low here, but look at the next low. The next low is a bit higher. And look at the next low. The next low is a bit higher as well. And look at the next low, also a bit higher. So it doesn't have to be perfect, but you can see that each low is higher than the previous one, right? And I can see also that the highs are higher, right? Each high is a bit higher than the previous one. So what does that tell me? That tells me we're in an uptrend. So the currency is going in a specific direction. USD is strengthening versus CAD. So it's taking more and more CAD to get you $1 worth of USD, right? And you might have heard the expression before, the trend is your friend, or don't go against the trend. Why? Because it's been proven that when something is going in a specific direction, it's more likely to keep going in that direction, right? When you have momentum, when you have a force in a specific direction, let's say a train going in a direction, it's hard for it to stop or go in the other direction. You need an opposing force that has, a force equal or bigger than that force to make it slow down or change its direction. And it's the same thing with prices. So when you see that there's a trend in a specific direction, you want to make sure that you're not going against the trend unless the trend breaks. Now, to be able to have a better idea on this, what we usually do is we draw a trend line. So a trend line is basically just a line that we draw on either all the lows or all the highs. I'll explain the highs later, but let's say on all the lows for now. And this trend line makes us really see the direction of the trend and when the trend breaks. So in this case, if I have a trend line here, you can see that whatever this product is, it's going to be supported. Why? Because everybody's looking at this trend line. So every time the price hits the trend line, people know that it's going to bounce off of it. And usually prices will bounce off a trend line. But when it breaks, it'll break and it'll go in the other direction. So if we go back to our example here, I can actually look at this chart and see, well, okay, can I connect these lows here? And I can take this line tool, trend line tool, and just see if I can connect them, right? And it doesn't have to be perfect, it's just an approximation, okay? And some people don't just draw one line. Some people like drawing two lines. So they'll take one line here and they'll do like a range. They'll take another line and they'll be like, well, because usually it's a range, right? It's not a perfect science. They'll be like, this is the support level, and they'll have like two lines. But for simplicity's purpose, let's just draw one trend line, okay? And leave it at that. You can tell yourself that, okay, well, because of this trend line, I see that the direction is upward. So the next time that this currency drops here and comes here, I'm going to buy it. Why? Because everybody else sees this direction and everybody else sees this trend line. So everybody else expects this currency to bounce off of this trend line. What does that mean? That means when the price comes here, they're all going to be buying, putting pressure on this currency and pushing it back up. So some people always wonder, well, do trend lines work because they work and it makes sense? Or is it because everybody thinks that they work, and because of that, they all place orders on these key locations, and because of that, it works? So is it really something that works, or is it a self-fulfilling prophecy? Everybody says it works, so everybody applies it, and because everybody applies it, it works. And we don't know. I think it's a combination of both. Obviously, the impact of everybody following trends and using them has an impact on it, but also there's something to it as well that makes sense. So we'll be drawing trend lines to be able to look at the direction and see if it's a good place to buy or sell. In this situation, if the currency comes here, I know it would be a good entry spot for a high probability trade. And if the price breaks it, I would not want to go long this currency because there's more likelihood that it breaks down. So this is what a trend line is. In the next lecture, we're going to explain support, resistance, and channels. In this lecture, we're going to look at channels, supports, and resistance. So what a channel is is basically two lines like this. So even from the example we saw in the previous lecture, you might have noticed that things, when they move in an uptrend or a downtrend or a side trend, they don't just have a line at the bottom. They have one at the top too, because it moves within that range. So I could have drawn this one here by adding another line. I could have just taken another line and connected the highs as well. And by doing that, I would have seen that the price here for this currency trades within this channel, right? And in this situation, I know that when the price comes here, there's a high likelihood of it going back down. So if I'm buying here, when the price comes here, I should sell because there's too big of a likelihood that it comes back down. And if I'm holding it, then I would have wasted all this time holding it for nothing. I could have bought here, sold here, bought here, sold here, bought here, sold here. Instead of just, imagine somebody else who just buys here and holds it. And he holds all this time. Well, he would have been from here to here, he would have been flat, not making any money. But somebody else who says, okay, well, I'm not going to buy here, I'm going to wait, and he buys here, sells here, buys here, sells here, makes way more money, and is only using the capital for a fraction of the time. So it's very important to look at this type of stuff, not only for where you're getting in, but for where you're getting out. And things usually trade within that channel. And that's not just in Forex. That's across products, in cryptocurrencies, in stocks, in anything. Things are trading within a channel. Now, what do we call this bottom line and what do we call this line at the top? The bottom line is what we call support. So when people are saying, hey, it's hitting the support, it's above the support, we're talking about the bottom line. Why do we call it support? Because it's supporting the price. The price is trying to go below it, but it can't because it is being supported by this line. So we call it the support line, okay? And this is when it breaks, people say, the support just broke because the price broke below the support. Now, the line above is what we call the resistance because for the price to go over it, there is resistance, it's causing resistance for the price. So the price isn't able to go over it and bounces off and goes back down, bounces off, goes back down. So this line we call the resistance. So resistance line is the one above, support line is one below, and the price is going to move between them. Now, that doesn't mean that the resistance is never going to break or the support is never going to break. They are going to break. It just means there's less likelihood of them breaking. Now, where do we find supports and resistances? Well, we find them around trends. When there's a trend, you're going to have a support and you're going to have a resistance. But not only in those situations, we often find support and resistances around round numbers. So this is not necessarily the only place where you're going to find support and resistances. You might find a resistance at a round number. So let's say at $1.50 here, there's going to be a resistance. Why? Because at round numbers, psychologically, it has an impact on people. So a lot of people might be like, well, you know what? At $1.50, I'm selling because it's too high. So there's going to be a lot of orders, a lot of people transacting at those round psychological prices. And same thing with prices lower. So you might say at a round number of 120 or $1 or 110, there's going to be a lot of buy orders because at those prices, a lot of demand is going to cause the currency to be supported. So supports and resistances are not only with trends, but they're just something that have to do with people placing buy or sell orders and affecting the supply and demand at particular price levels. Okay. And this happens often at round numbers. Now, the more round the number is, the bigger the impact is. At $1, that's a very big round number. $2, very big round number. Well, 150 is also round. Well, 110, 121, those are also round. 115, 120, 125 is also round. But some of them are less round than others. So again, we'll go from $1, $2, that's very round. 150, that's round. 125, that's round. But then, 110, 120, 130, those are also a bit round, less than the others. Then 115, 145, 135, they're also round, but a bit less than the others. So the impact is going to be less on those than others. But every single round number that you have, there's going to be a bit more supply demand. So bigger potential for support and resistance than at regular prices, because people don't think often of, yeah, I'm selling at 142.22. No, they'll be like 150, So you'll have a lot of support and resistance at those levels. And again, the rounder the level is, the more of a support or resistance it's possible to be there. Now, another thing that we want to look at is one of the properties for supports and resistances. And this property is role reversal. So when a specific resistance or support breaks, it actually reverses and becomes the inverse. Example, if we had, let's say, this support here that we have, and the price, oops, let me take this off, and the price all of a sudden breaks down, okay? Let me see if I can draw it here. I'll take the brush, and the price breaks down, okay? Well, what happens if the price comes back up? You know what's going to happen? This support line is now going to become a resistance, and the price is going to bounce off of it and go down, and it might bounce off of it several times. So supports and resistances tend to reverse their roles once broken. And same thing with round numbers. If, for example, the price of this currency decides to just went up and then broke, let's say it bounced off 150 a few times because it's a round number and there's a lot of resistance, but then broke over it. Well, you know what? It might now become the new support, and prices might now bounce off of the 150 in this way. Now, why is that? It might be because of a psychological effect. So people at one point were saying, oh, 150 is too high, it's too expensive, it's not going to break there, and they're just selling. But then once that breaks and it goes higher, well, when it comes back to 150, people are like, oh, it's back there, I can finally buy, it's not as expensive as before, and they start buying at that price. And this also have been proven often. So round numbers, or not only round numbers, but any support and resistance, when they break, there's a very big likelihood of them changing and becoming, the inverse. So let me, even if I check real quick right here, let's see, I'm looking at this support here, but let's say I'm looking at this one. Look at here. Sorry, my camera just shut off, so I had to replace the battery real quick. So to continue where I left off, if I'm looking at this chart here and I'm trying to find some supports and resistances, real quick here, I can see that, there's a resistance here. But look at this. When this resistance, okay, when we broke over it, look at this, it became the new support and prices started bouncing off of it, right? Now, I'm just looking at this real quick, but often what you're going to find is things are going to trade in ranges. And when they break the range and they go in another range, the resistance becomes the new support, right? And if it breaks the support is going to become the new resistance. So that being said, go on TradingView and create a list of currencies of the major pairs and go over them and see if you can spot some supports and resistances and draw trend lines on them. So you can see if you can find some channels that will give you a general direction for that currency. This will give you some practice into looking at charts. And of course, don't worry if you don't spot them right away. This skill gets better with time as you look at more and more charts. In this lecture, we're going to be looking at volume. So volume is the other thing that you look at that's part of technical analysis. You have the charting, so the prices, because all of these come from prices, but you also have the volume. And the volume is this thing you see at the bottom. And the volume is basically the quantity of funds transacted, right? So the more money is transacted, the higher the volume is. Now, why would you care about volume? What would volume tell you? Well, does it make a difference if there's $1 billion that were transacted or $100 billion? Yes, it would, right? If you're looking at real estate and all of a sudden you see that prices of houses in your neighborhood increased because one guy bought a house at a very high price, Does that give you an indication that prices will continue to increase? No, it's just one guy. But let's say all of a sudden there's hundreds and hundreds of people who start buying and selling at higher prices in your neighborhood. Well, would that give you an indication that prices are increasing? Yes. And sometimes you'll even see the volume, the quantity of transactions increase before the price increases. So you'll see that a lot of people are buying and selling, and then you'll slowly see prices going in one direction as there is more demand than supply, or supply than demand, right? So the quantity of transaction has an impact when, and is very necessary when prices move in a direction in a strong fashion. Otherwise, they might just revert, and it might just be because of a low amount of supply or demand. That's why something went up. Let's say there's 5 people who want to buy houses in your neighborhood, but nobody's selling. Then prices might go up, but it wasn't pushed up by demand. It was just a lack of supply at that time. So I would prefer seeing hundreds of transactions and the prices going up to tell myself, hey, it's demand that's pushing up prices and not a lack of supply. So in the same way, when you're looking at volume, you know that for directional moves, if there's a lot of volume, you have more confidence in them. And if you want a change in directions, it's also necessary that it comes with big volume. So if I look here, let's say I'm looking at Australian dollar here. Okay. Well, I can see here. Okay. So I can see here there's a spike of volume here. So volume was pretty low. And then at one point, prices really dropped. And you can see here that volumes really spiked. And then when volume spiked a lot here, we stopped. And then volume really kept on spiking, and prices went back up, and then we recovered. And even here, you see that there's a bunch of volume. So volume was pretty okay. And then at one point, volume really spiked. And you can see that volume spiked actually here. You can see here there's a volume spike. Okay. And this is here, right? So prices hadn't even dropped. And then prices dropped with an increase in volume. So everybody was agreeing with that. There was a lot of selling, and that's what pushed prices down. And you can see then we had a change in directions. Oops. We had a change in directions, and prices started to go this way. Okay. And you can see that if you are looking at volume, that might give you warning that something might happen. And you see that volume's coming in, and you'll be like, okay, well, let me just step away and see what happens. And then when, we broke down here with high volume, then you might say, okay, well, look, we're breaking down and there's high volume. I think that this is going to keep going in that direction, because it's not just a few people or a bit of money that's saying that. It's a lot of money that's saying we're going in that direction. And then you might take a trade in that direction. So volume helps pretty much. So always have an eye out on volume, regardless if you're trading 1-day charts or if you're trading 1-hour charts or 30 minutes. When you're looking at volume, it might tell you when something is going on, right? It might tell you something is about to happen, or something is happening, and you might want to take off your orders, not trade for that period, or wait until something happens and enter a trade in the same direction as the volume. So it's very helpful. So make sure you always have it on your charting. So in this section, we're going to be looking at chart patterns. Chart patterns are a subsection of technical analysis. And basically, chart patterns are patterns that you see on charts that have historically shown that if these patterns show up, there is more likelihood that the price of this financial product would move in a particular fashion. So either this pattern, once it breaks or once it forms, there's more likelihood that prices will move in a certain type of way. So chart patterns are used because they are believed to have predictive value on future price movements. And traders are going to be using these chart patterns to choose a entry and exit points while they are trading. So they really help you systematize your way of trading. If you want to buy something, well, you could look at chart patterns and figure out where exactly to get in, where exactly to get out, and reproduce that type of trading through looking at similar patterns and reproducing those trades. This being said, why do chart patterns work, and do they work? Now, there's a bunch of chart patterns out there. You can see lists of, dozens and dozens, I want to say hundreds of patterns, some not widely known. So are you going to learn all these patterns? What patterns are good? What patterns are not good? The thing is this, a lot of these patterns, if everybody believes a pattern is going to work, it might be a self-fulfilling prophecy, right? So if I tell you, if you see, a rabbit, then the price is going to go up. Well, what if everybody looks at that and everybody believes it? And obviously you can't have a rabbit on a chart, but let's say if I say, if you see a triangle, well, prices are going to go up. Well, what's going to happen? If a triangle forms at one point, for a reason or not, then if all the traders know about that and everybody believes it, then all the sellers now believing that the price will go up are going to cancel their orders. And all the buyers who believe that it's going to go up might buy at more aggressive prices. And thus the price will go up because we believe that this pattern would cause the price to go up. So it's a self-fulfilling prophecy. Now, it's not because some people know about these chart patterns that they will work. Some other patterns make sense. So some patterns, they actually make supply and demand sense. So when you think about them, it makes sense that if you see that chart pattern, prices will behave in that particular way. So the patterns that I like to look at are patterns who have reason behind them. Because all patterns have this, self-fulfilling prophecy type of mentality behind them, where you could say, well, everybody sees them, so that's why I'm going to use them because everybody knows them. But then you're not putting all the odds in your favor. If you want all the odds in your favor, just choose the patterns that have more meaning to them. Not just because everybody knows them, but because there is more meaning to them. Everybody knows them as well, but there's meaning to them as well. So the patterns that I'm going to show are the ones that I think are the most valuable. Some of them I'm not going to show. And if you have a recommendation for one that you think is valuable, put it down in the Q&A section, and I might add it if I believe it's of value. But for the time being, I'm really going to put the ones that I think are the most beneficial. So you don't just have a list of a bunch of patterns that aren't going to add value to your trading. So the first pattern we want to look at is the double top, double bottom, or multiple tops, multiple bottoms. So it's, I guess, 4 different types of patterns here. Now, these patterns work across financial industries. So you can be trading currencies, you can be trading cryptocurrencies, you can be trading stocks, futures, whatever you want. These patterns make sense in any type of product. Okay. Now, let's say the double bottom. The double bottom is basically when you have a financial product and it touches a low point, goes back up, and touches this low point again. We call this double bottom. So it hit this bottom twice. What that tells me is that if we get back to this level, there's going to be a lot of support because everybody sees that this is a key support level. There's a lot of demand at that level. And if prices go down there, what's going to happen is the prices are going to bounce off of that level and go back up. So if you are a trader and you're looking to get into a long position and you want to go long this product, well, a good place to put your buy order would be just above this support level. So if the prices fall, you are likely to just get filled and then prices going up where you start making money because there's a lot of support here and there's a lot of other buyers at that level. And this is what we call a double bottom. Now, you can have a triple bottom, which is when the prices tests that level more than 2 times. So that would be a triple bottom. And this is why we call it multiple. There's multiple because it can, test it 4, 5, 6, 7 times. And the more times it tests that level and bounces off of it, the more robust this level will be because more people will see it. It will have a stronger impact and it'll be a stronger level. So that being said, this is what, a double bottom or a multiple bottom would be. If I have another chart here, if you look at this here, we have a multiple bottom. So it touches a level here, comes back to it, goes back up, comes back to it. So again, if you would have just seen this double bottom, then you might have been able to buy here and make profit on this move. But now there's a triple bottom or multiple bottom. And now if the prices go down again, you can rest assured that there's going to be a lot of support at this level, and you might want to put a buy order just above it in the case that you want to buy this product, right? So this can be used to, give you an indication of where there's going to be a lot of demand. Now, if you want to look at the tops, it's just the inverse, right? So if prices are going up and they touch a level here, goes back down, touch the level again, well, here we have a double top because it touched this level 2 times. So you would be thinking that if it gets back to this level, we're going to bounce off of it and go down. And, this is what happened here. And now we have a multiple top because it touched it more than 2 times. So we have several times that it touched this level. So there's a resistance at that level, a lot of sellers, because a lot of people think that this is too high of a price. Now, when you're looking at the Forex market, you can try and understand, well, and actually let's open a Forex chart right here and it'll make more sense. Let's say I'm looking here at, let's see here. Well, we could say here that there's a double bottom here. And if it goes back down to this level, we might want to buy. We could say here, well, let's see. Well, here we had a triple bottom here. So let's draw a line here. So initially, if you're trading this currency, you would be like, okay, well, you know what? I have a double bottom. We hit it here. We hit it here. Then if we're coming back to this level, you might want to put a buy order here if you're looking to buy this currency. So why? Because you know that there's a lot of support at this level, and here it bounced off of it. And look at this. Now, even if you missed these, there's a triple bottom here, so multiple bottom. If you extend this line, you'd see that it bounced off of it again. And let me just put this. It bounced off of it again. So you could have, if you wanted to be long this position, you wouldn't buy it just here or buy it here. You would wait to buy just above a certain support level. And you would have been able to buy here and make profit on this move. You might have probably, if I was trading this, I see that there's a bit of resistance here as well. I might have been able to buy somewhere like here, let's say, I would be able to buy somewhere here because I know that this is a support level. And then as soon as it touches the higher resistance level, I would have sold and made this amount of profit, right? Now, you can fall into the practice of thinking, well, why is there a support here? Why is it bouncing off this level? Why is it not bouncing off of that level? And try and understand it. Because you could argue, or you can try and say, okay, well, for these currencies, if the currency falls above, let's say if I put USD CAD, if the currency goes to $1.50, you know what? Then the Canadian dollar is very cheap versus the US dollar. And then there's a lot of exports that are happening from Canada to the US because now the Canadian dollar is very cheap. And because of that, there's a lot of currencies exchanged to be able to buy these products, and that causes the demand to fluctuate from here and there. But this is fundamental analysis. This is not technical. And if you're a true technical analyst, what you're saying is prices will reflect this fundamental information. So you don't need to do it. It's already in the price. If prices are bouncing off these levels, you don't need to understand what exactly is the reason. Is the reason because companies are selling at this level? Is it because traders are selling at this level? Is it the government that doesn't want the currency to go over that level and trying to manipulate the currency? You're just seeing that this is what is, and you are going to profit from that because you are seeing it through the chart. Now, we will look at fundamental analysis in a way, but just to let you know that when you are a true technical analyst, and which I don't suggest that you just do technical analysis, you should do everything. But the mindset is that this other information is reflected in the price. So when you are looking at prices, it's not necessarily that important to see, well, what exactly caused it at that price to revert, just that it is more likely that it reverts when it touches that price. And this is, what, bottoms and tops and resistance levels can help you do. it can help you figure out an entry point, an exit point, so you can get in, get out, and move on to the next trade. So this does it for multiple tops, multiple bottoms, double tops, double bottoms. And I'll see you guys in the next lecture. In this lecture, we're going to be looking at ascending and descending triangles. So first off, ascending triangle, what is it? So it's basically when you have prices going up and they're being wedged in a way. So you have prices going up here and they're hitting a level, which is a resistance level that's stable, okay? But then every time they're going back down, they are supported by buyers. And then it's going back up, but then sellers are selling at the same level, okay? So they are as confident in this level. Now, as prices are going down, buyers are being more aggressive. So they're buying at higher prices. So the lows here are getting a bit higher. And then prices goes up and sellers are consistent about their price, pushing it lower from here. And then they keep pushing it here. But buyers keep pushing their buy orders higher. So then the price is getting wedged in a way, okay? The thing is, you can see that sellers are very robust on a level. There's a lot of sellers on this resistance level. Buyers are being more and more aggressive. So what usually happens, and it's not always the case, is in a ascending triangle, so a triangle that's going up, buyers will win at one point and the sellers are going to be completely executed. They're going to sell whatever they want to sell, and buyers are going to push the price higher, and then the price will explode in this direction. Now, you never know if it actually will or will not. Sometimes sellers actually win, buyers are exhausted, there's not enough of them, and prices go down. So when you see an ascending triangle, the right way to play it is wait until there is a break. And if the price breaks above, then you can get in here, expecting the price to go higher. Now, if it doesn't and it breaks below, then you can get in on a short position, expecting the price to go lower. Even though there is more likelihood that it breaks up, it's a smaller likelihood, right? You always want to wait until the break to get into a position whenever you're looking at any type of triangles. So this is the ascending triangle. The descending triangle, we'll actually draw it here, is just the inverse, okay? So you would have a chart and you would have the price of your currency here. That's basically going down in a way, and it's hitting a level, and then it's going back up, and it's hitting back the same level, going back up, hitting back the same level, going back up, and you can see here that there is a triangle here, and this is, I guess, straight, and the triangle is dropping here. Right? So the price is getting wedged here, and at one point it's gonna break. Now it could break either way, but it's more likelihood in a descending triangle that it breaks down. And this here, which is the support level, which was supporting the price at multiple times, once it breaks, it becomes the new resistance, and prices might tumble down. Okay? Now you never know if this is going to happen, so you always wait until this happens so you can enter your position after it breaks, right? Because you don't know, it could have broken up, right? The price might have broken this way. Let's get the same color. Might have broken this way, right? So you never know. And this is why you want to wait until the break before getting into a position. But this would be the descending, right? Descending triangle. The other one was the ascending triangle. These ones you want to look out for because they happen often, and they can help you in getting, an entry and an exit, and then moving on to your next trade. That being said, I'll see you guys in the next lecture. In this lecture, we're going to be looking at symmetrical triangles. Now, the only difference between symmetrical triangles and ascending and descending triangles, it's that basically both supply and demand are being more aggressive. So instead of having, a resistance level that's flat, like in the ascending triangle, where, sellers are selling at the same price, or a support level that's flat, like in the descending triangle, where the buyers are buying at the same level, so there's a support. In this situation, both buyers and sellers are being more and more aggressive in their prices. So as you see here, you can have something that's going up and then sellers are, coming in, pushing prices lower. Then buyers are coming in, pushing it higher. Sellers coming in, pushing it lower. Buyers coming in, pushing it higher. And the price really gets wedged in between. And at one point, one of them is going to win, either buyers or sellers. And the further the price goes within the triangle, I'll try and explain it here, the more the explosion could be bigger, right? So let's put it up here. Imagine this. Imagine I have prices here. I have a triangle. And then I have prices that are fluctuating. Let me actually draw the triangle here. It'll be easier. Okay. Let's actually take this off. Let's say I have this triangle. Okay. Imagine this. Imagine I have prices. Buyers pushing it up. Sellers pushing it. Buyers pushing it. Now, if I break here, okay, prices might tumble because I have this triangle. I kind of see it. But imagine this. Imagine the price actually goes all the way within the triangle. So it gets wedged more, right? Buyers push it, sellers push it, buyers push it, sellers push it. And, we get really deep within the triangle. Once somebody wins, either the buyers or the sellers win, so the explosion is going to be way bigger than if we broke somewhere around here or around here. So the further we go within a triangle, the bigger the explosion could be. So this is what we would call a symmetrical triangle. It's basically a triangle where both supply and demand are being more and more aggressive. You can't truly know which way it's going to break. So you always wait until the break happens as a confirmation, and then you can enter your position in that same direction. That being said, this is symmetrical triangles, and I'll see you guys in the next lecture. In this lecture, we're going to be talking about wedges. So again, wedges are another type of triangles. And you know what? For me, I see all of them in the same way, right? I don't remember, this one is a wedge, this one is a symmetrical, this one is because it's all the same thing. It tells me something about supply and demand. And this is why I really like these chart patterns that have to do with triangles. So a wedge is basically another type of triangle where it's not very symmetrical in one direction, it's not symmetrical in the other, and it's not symmetrical in both. It's just a triangle. Okay. So you can see again where you're going to be having supply or buyers buying at more and more aggressive prices, sellers at more and more aggressive prices. Now it's not going to be symmetrical at all. So maybe buyers are going to be way more aggressive in their buying and sellers slower, less aggressive in their selling, but not in the same way as a ascending triangle. So they could even be selling at slightly higher prices. It's just that both, if you look at the resistance level and the support level, they are going to meet at one place. And that's what we call a wedge, because the price is going to be wedged between them at one point, right? And the same thing with the triangles. The more the price gets wedged further within the wedge, the bigger the explosion could be. And the same thing that we've learned about resistance and support. When a resistance breaks, it becomes the new support. And when a support breaks, it becomes the new resistance. Okay. So these are wedges. You'll see different type of wedges. Again, here in this situation, buyers were way more aggressive and sellers, fluctuated a bit. So you are going to often see these type of patterns, and these are the patterns that I like the most. The reason why I really like these triangle patterns, and I show a lot of them, is because they are one of the best patterns out there. They make sense, right? So there's a sense why they work, not just because it's a self-fulfilling prophecy and everybody knows them and everybody sees them, but it is a battle between buyers and sellers, and you can see that through the chart. So there is an underlying sense behind them. Second is because they're very easy to see. So when you're doing something, because it's a self-fulfilling prophecy, you want to make sure that everybody else sees it, right? So everybody sees these triangles. And this is the reason why I really love these patterns, and I show them here in this course. Some other patterns that you might have heard of, like head and shoulders, don't really make sense. Because yes, a lot of people know about them, but even though you might say, well, because they know about them, it'll work just because it's a self-fulfilling prophecy, they're very hard to find, to see. And if nobody really sees them, or not everybody sees them, then that self-fulfilling prophecy isn't really going to hold. And second, something like head and shoulders, well, it doesn't really make sense, right? So even if there was the self-fulfilling prophecy part of it, the logical part behind it isn't strong. So I don't want to look at patterns like that don't make too much sense and that I haven't seen work really well. I want to look at patterns like this that are easy to see and that have logic and sense behind them. And this is why right now we just looked at wedges. Keep an eye out for them. See if you can find some on the charts that you're trading. And this is going to be it for wedges. And I'll see you guys in the next lecture.
Hey guys, this is just another reminder that if you want to follow us on social media, the social media links that you've been seeing through the course are not valid anymore, as I have started a new company called Bloom Trading in place of MTG. So if you want to follow us, make sure to follow us on the new social media handles, which I'll put on this side. If you want to follow me personally, it's on this side. Just pause the video, look at them, and follow us on those social media handles.